So you found that stock that you want to buy, and the question is, how many shares do you buy? Well, this week I'm going to tell you exactly how to make that calculation. Plus, I will do my regular weekly market analysis. We'll do a market scan in search of trading opportunities and the day trade of the week on HTBX. So it's common when people find that stock that they want to buy that they think about buying the number of shares that they can afford. And that's not always the best way to do it. We should really be focused on how much you are willing to lose, how much you can sleep well on if the position is going against you. And so the position size that you take when you are buying a stock should really be based upon the risk of that stock and its historic volatility. Now, those things will make a little more sense when I show you on a chart. But let's start with some of the basic concepts. Position sizing is an important factor in managing risk. Now, every stock has a different amount of risk because every stock has a different amount of price volatility. And we're going to end up buying less of a very volatile stock. So those, really low price stocks that are maybe under $1, they can move 10-15% in an hour very easily. And so we're going to buy less of those in dollar terms. But when we're considering those more blue chip, large cap companies that don't have as much price volatility, well, we're going to buy more of those in dollar terms. And this will again make a little more sense in a moment. Now what we end up doing then is we make every stock have the same amount of risk because we buy less of the more volatile stocks and buy more in dollar terms of the less volatile. Now we're going to use the stock's trading history to define where we should put our stop loss point, and then we can calculate how many shares to buy. So let's take a look at a chart, and this is a stock that I featured to my subscribers on Wednesday, and the reason, very simply, it was doing what I call a bottom fishing pattern. So we had rising bottoms building towards a flat line of resistance, and then it broke out on Wednesday with strong volume. That's a strategy I use called a bottom fishing strategy. We broke the downward trend line, we built a rising bottom, and then we broke up from a rising bottom on Wednesday. Now what we're interested in today is how to size the position. We're going to use Wednesday's entry point to do that. So the entry price was there on Wednesday at $4.20. I always like to set my stops a little bit below the last inflection point low. Now an inflection point low is the point where price stops going down and starts going up. And so we're going to use that price level, which is essentially right about there. And that was $2.80, just for round numbers. That's what we're going to call it. So entering at 420, hopefully some of you can see the irony of that. This is a cannabis stock. And the support price was $2.80. And that meant that there was $1.40 in risk for this trade. Let me write that out a little bit better. So the risk of this trade is the difference between the entry price and the stop loss price, which is $1.40. So if we buy one share, the risk is $1.40 plus the commission to buy one share. If we buy 100 shares, the risk is 100 shares times $1.40 is $140, again, plus the commissions in doing that trade. So let's say commissions are $10. Essentially, if we're buying 100 shares, our risk will be $150. Now, what you should do when you are calculating your position size is work backwards from how much you are willing to lose. If you're willing to lose $150 on a trade, in this example, you would buy 100 shares. If you are willing to lose $300 on any one trade, then you would buy 200 shares roughly, because 200 times $1.40 is $280. Add on a little bit for commissions, it rounds off to about $300 of risk. So that's always the calculation that we want to do when we are trying to figure out how many shares to buy. When we talk about your risk tolerance, in this example I'm using your risk tolerance is $150. That's how much you're willing to lose. Well, everyone's going to have a different risk tolerance. and it's dependent upon how much capital you have, how experienced you are as a trader. Most importantly, it's based on what makes you sleep well at night. If it bothers you to risk $1,000 on a trade, then you need to scale back the number of shares you buy until you get to a point where the risk of the trade reflects what allows you to sleep well. And that's always the test, I think, is what allows you to sleep the best. So very simple calculation, and to summarize, we take the entry price, we subtract from that our stop loss price. In this case, it's about $2.80. The entry price was $4.20, and so the risk was $1.40 per share. And if we're willing to lose $150 in any one trade, we would buy 100 shares. All right, let's get into this week's market analysis, starting us off with the US markets. And here is the S&P 500. Now, if you were with me last week for this video, you'll know that I talked about a little bit of concern because we had broken that little upward trend line, but we ended up bouncing back quite nicely to start the week, gapping up into resistance. And so if you were with me on my active live service, which I run every day, my comment on that particular day was, okay, we've kind of gotten out of the little bit of cautionary note. We are back into the upward trend, but because we gapped up into that resistance level, we should expect that we're going to go sideways for a little while. And that's exactly what we did. For most of this week, we have just simply been trading sideways. However, the bottoms are rising over time, and so you can see, therefore, that the buyers are in control, and that makes this short-term bullish. Looking at the long-term chart, you can see that we had the big sell-off, of course, where we lost a dramatic amount from just about 340 on the SPY down to 220. We have recovered more than half of that. That was about half right there. So we are now inching up slowly but steadily as the market starts to price in perhaps a turnaround in the economy from the COVID pandemic. Certainly some companies are still really languishing. You see weakness in the travel-related companies because, of course, they are not going back to business as normal. But other companies are actually doing quite well. I was looking at the chart of Lululemon, and perhaps because so many people are sitting at home in their sweatpants, Lululemon is actually above where it was before the pandemic took hold of the stock market. So there's always hidden gems in the market, and of course there are those who suffer the most. All right, moving along to the Canadian market, we have the Toronto Stock Exchange short-term chart, 30-day, 60-minute chart. You can see that we're pretty much going sideways. We've been doing that for about a month after the bounce back, and a fair bit of volatility here. Of course, lots of energy names on the Canadian stock exchanges, and those stocks are, showing lots of volatility. There's great trading opportunities in individual stocks, but I wouldn't say that the overall market is helping here. It's not really hindering either. It really comes down to being a stock picker's market. Looking at the long-term chart, very similar to the S&P 500, you had the dramatic sell-off. We've made back a little better than half the gains. Canadian market is underperforming the US in the last couple of weeks, as perhaps the commodities in Canada may be dragging the market down here, most notably oil, of course. But I do see some recovery happening in oil. We'll talk about that in just a moment. On the TSX Venture, which is those small cap, micro cap Canadian companies, we've had a great recovery, largely fueled by the gold stocks. The miners have been doing well, as central banks are printing lots of money, doing all kinds of stimulus to keep their economies going, and that of course helps gold move higher, and many gold stocks are listed on the TSX Venture. Moving along to the currencies, and here we have the US dollar, had lots of volatility in March, and it's sort of gone back into a narrow sideways trading pattern. The long-term picture here for the US dollar is bullish, but short-term it's just sort of neutral as we grind our way sideways. Now the Canadian market, I'm showing a weekly chart because you can see the parabolic move to the downside. We broke that downward trend. We're now starting to build a rising bottom. And what we need to see is a break up from this rising bottom. And if so, we should get back to those old levels. However, until we get the break out from this pattern, I would say it's a neutral to slightly negative chart pattern because the tops are falling over time. On to interest rates. Here is the chart of the 20-year Treasury bonds, US Treasury bonds, and if this goes up, interest rates are going down. And you can see that interest rates have come down a long way. However, they're still in a downward trend because this chart is still in an upward trend. Been pretty sideways the last 2.5 months, and so there's not a lot of volatility in interest rates anymore, but it's a good time to borrow money because interest rates are low. On to commodities. We're going to take a look at that important gold chart, which has shown a lot of volatility in March, and since then it's been fairly quiet, but still the bottoms are rising, and that is a sign that the buyers are in control. And so if you see trading opportunities in individual gold stocks, certainly the market isn't going to hurt you because we do have an upward trend for gold. I do think it's a little overextended. I'm a little bit worried that we could get a break of the upward trend line, but until that happens, I would remain a bull on gold long term. Short term, kind of neutral. We've been grinding our way sideways of late. Looking at the oil market, and this is the chart that I told everyone to watch this week because last week we started to break up from a rising bottom. You can see this low is lower than this low, so we had the rising bottom. We were also breaking this downward trend line recently. So you're starting to see some recovery in oil. Now, by no means is it particularly exciting yet. The volumes are still quite low, and the downward trend line, the resistance zones here are going to still be an issue, but at least it's starting to build rising bottoms. And I do see, the odd decent trading opportunity in energy names, and we've actually bought a few in recent months because those stocks have been performing well. You got to think about it. A lot of these stocks have been put on sale. If they have the balance sheets to ride out the weakness in the oil market, they can be the ones to acquire some of the weaker oil companies, and ultimately the companies that come out of this real sharp sell-off are going to be stronger for it. So there are good opportunities here, but you have to be selective. And then finally, the fear chart. You can see that fear is generally slowly grinding its way lower. We have slowly falling tops. So fear is coming down, but it is certainly not out yet. All right, so my ratings then: US stocks neutral long-term, bullish short-term. Canadian neutral on both time frames. Gold bullish long-term, neutral short-term. And oil neutral long-term and bullish short-term. We do have a little bit of buying power in the last week. So while volatility is coming down, there are still plenty of stocks making big moves. And if we focus on those alpha stocks, those stocks that are trading with abnormal price, abnormal volume, breaking from low volatility patterns, those alpha stocks, having a focus on those is paying off. And there's lots of them right now. This is a really good stock pickers market, but you have to have a methodology to find them. Gold continues to be strong, and oil is trying to overcome from its weakness. Fear is coming down, but it is certainly not out. All right, now we're going to do a market scan on the Stockscores website. So we'll jump over to Stockscores here. And what I'm going to do is run a scan on the Canadian market. And the reason I'm going to do Canadian this time, we're going to run the abnormal break scan, is because this past week there were a lot of good trades happening in the cannabis sector, and a lot of these cannabis stocks are listed on the Canadian market. So I thought, let's run a market scan on the Toronto Stock Exchange in search of some of these cannabis names that may be reversing their long-term weakness. And here you see Village Farms, which is the stock that I used as an example. It gave a buy signal on Wednesday. What I want to see now is whether it's still worth considering, but more as a long-term trade off of the weekly chart. One of the cool things that you can do with Stockscores is quickly change your chart timeframes using these links at the top of the chart. So I'm going to click on 3-year, 3Y, and that will convert this to a weekly chart. And then I can blow that up and see, is this really a good long-term chart for a hold that maybe would last months rather than just days? And there's an issue there. I can see that although VFF had a good break on Wednesday and probably is going to maybe make it up to the $9, $10 range, when it hits that $9 to $10 range, it's going to be hitting its long-term downward trend line. And so although I liked VFF as what I would call a swing trade, where we're maybe in and out within a week, maybe 2 weeks, I don't really love it as a longer term trade yet because it has not yet broken that long-term weekly downward trend line. Now you always have to adjust or focus in on the chart that matches the type of trading you want to do. If you are a swing trader, then you're looking at the 13-minute or the daily chart. If you're a position trader, then you're looking at the daily and the weekly chart. And of course, when I'm day trading, I'm looking at the 2-minute chart and maybe the 13-minute chart with some check of the daily chart. So you can get very different messages when you look at these different time frames. So here's another cannabis stock. This is Charlotte's Web Holding, and you can see a very similar pattern to what we saw on VFF, where we've broken the downward trend line, we built a rising bottom, and then we're breaking from a rising bottom. And it did this more at the end of the week. You can also see volume coming in. So this looks like a pretty decent chart pattern. We may get a little bit of resistance here at $12 because that was an old inflection point high. But generally speaking, I think that is a decent looking stock for your consideration. This one, I don't like it for the amount of volatility that has been happening lately. It started its move, and again, there was actually a bottom fishing pattern back here after it had broken the downward trend line, built a rising bottom, broken from the rising bottom. That was at $1.20. Now it's at $1.50, and resistance is here at $1.60. So it doesn't have a lot of upside anymore. If you bought this stock last month, good for you, but I would not be initiating a position here, although it remains a hold for someone that is long of that stock. So those are the sort of techniques that I use when I'm analyzing charts to try and figure out if it has the right pattern. This one, a real cheap stock. I don't love it for the fact that it's very low price and not very liquid. It only traded 340 times, but it has a pretty good pattern. It broke from a rising bottom, volumes coming in. Yeah, it can probably get up into the 20-cent range. It's at 12 cents now, 11.5 cents now. So that's a pretty decent gain. But remember, size your positions based on the risk. And so your entry price is here at 11.5. Your stop loss price is down there. Looks like about 7.5. And so you take the difference between those two and size your position using that difference with the techniques that I taught you at the top of this video. All right, so that's a quick little market scan. We'll get back to the Stockscores presentation here and take a look at the day trade of the week, which was a stock that we found on Friday using my action candle indicator. So of course, if you are new here, you maybe haven't heard about the action candle, but it's something that I run an algorithm on all day long with a service that we call Active Live. Active Live allows you to watch my screen where my analysis algorithm is running through every US listed stock looking for those that make what I call an action candle. Now, an action candle is this candle right here, and what it essentially is a strong price move on the 2-minute time frame with strong volume. You can see that the volume at that point was higher than any bar before it, and it broke from low volatility. So when we talk about alpha stocks, that's really what we're talking about, is stocks breaking from low volatility with abnormal activity. Now, it's very hard to find these if you don't have some method to find them, and I created an indicator called the action candle. I can apply it to every stock listed on the US stock market, and it will spit out all of the stocks making action candles through the day. There tends to be as many as 400 in a day. Often it's less. It may only be 100 or 200. This past week it's been a little bit quieter. But when we combine the action candle with the pattern recognition, which is what we're doing in Active Live every day, you can find winners like this. So in this particular case, for $100 of risk, using that calculation I showed you earlier, the position size was 9,250 shares, which required $7,000 of capital. Now, we often think that lower price stocks, and this of course is a stock under $1, will be less capital intensive. But in this case, it's actually fairly capital intensive for that $100 risk tolerance. You know, many of my day trades of the week often require less than $2,000 of capital for the same amount of risk. And the reason that this one is more capital required is because it's actually a less volatile stock, even though it is a cheap stock, under $1. All right, so if we go through the economics, because it is under $3, we cannot margin this stock, which means we have to put up all of that capital, all $7,000, in order to buy the 9,250 shares that our risk management calculation tells us to do. Well, that meant that at the end of the day, this stock had made $711 before commissions, and on $100 of risk, that represented a 7.1 RR gain, risk reward, for a 10% return on a one-day hold. Still a great trade. I mean, to make 10% is awesome, but the point that I have in showing you this stock this week is that some stocks will just be more capital intensive, and therefore the percentage gain that you get out of the trade will be less. And don't be fooled by the fact that because it's a cheap stock, you don't have to buy as much of it. It's still, for the amount of risk you take here, fairly capital intensive. All right, well, that has been the Stockscores Market Minutes for March 25th, 2020. Please hit the like button, leave a comment, subscribe to the channel, tell your friends, and most importantly, trade well.